Hello class, and welcome. When a company sells a product or service, the listed price is just the beginning of the story. What happens when a customer returns an item? Or when you offer a discount for early payment? The revenue a company is truly entitled to receive can be affected by several factors. Today, we are going to explore how we account for these situations by learning to calculate net revenues, sometimes called net sales. Specifically, we will cover four common types of transactions that reduce gross revenue: trade discounts, sales returns, sales allowances, and sales discounts. Let's use some examples to see how each of these works. Before we can reduce revenues, we first need to understand how most business-to-business revenue is recorded. While we are all familiar with cash sales, many companies operate using credit sales, also known as sales on account. A credit sale occurs when a company provides goods or services to a customer, but receives a promise of payment in the future instead of cash at that moment. Why do this? The main benefit of extending credit is that it often increases the seller's profitability by making it more convenient for buyers to purchase their goods and services. This creates a new asset for the seller called accounts receivable, which represents the amount owed to the company by its customers. Let's look at a basic example from FYI. On the 1st of March, FYI provides services for $500 on account. The company has earned the revenue and is entitled to receive the $500, so we must record the transaction now. The journal entry is a debit to accounts receivable for $500, which increases this asset account. We then credit service revenue for $500, which recognizes the revenue earned. This single entry has an immediate impact on the financial statements. On the income statement, revenues increase by $500, which increases net income. On the balance sheet, the asset accounts receivable increases by $500, and this increase flows through net income to increase stockholders' equity, keeping the accounting equation in balance. Later, on the 31st of March, when the customer pays the $500 they owe, the company makes another entry, a debit to cash for $500 and a credit to accounts receivable for $500. The second entry simply swaps one asset, the receivable, for another asset, cash. It has no effect on the income statement. This is the standard, straightforward process. But what happens when things like returns or discounts complicate the collection? That's what we'll explore next. First up are trade discounts. These are reductions in the listed price, often for bulk purchases or specific customer groups. The key accounting rule here is simplicity. We don't track the discount separately. We record the revenue at the final discounted price. For example, FYI provides a $3,000 laser eye surgery, but offers a $600 trade discount. They simply record the sale for $2,400. The journal entry is a debit to accounts receivable for $2,400 and a credit to service revenue for $2,400. Next, let's look at sales returns. First, imagine FYI sells sunglasses for $200 on account. Now, suppose the customer returns them. We need to reduce the accounts receivable, but we don't just erase the original sale. Instead, we use a special new type of account. The entry is a debit to sales returns for $200 and a credit to accounts receivable for $200. Sales returns is a contra revenue account. Contra means opposite. It has a debit balance, which is opposite of the normal credit balance for a revenue account. We use a contra account to keep a separate record of the total returns, which is important information for managers, without altering the original gross sales figure. A sales allowance is similar. It's a reduction in the balance owed when a customer is dissatisfied but does not return the goods. For a $400 sales allowance, the entry is a debit to sales allowances for $400 and a credit to accounts receivable for $400. Like sales returns, sales allowances is also a contra revenue account. It's important not to confuse these with expenses. They are reductions of revenue. Finally, we have sales discounts, which are offered to customers to incentivize quick payment. You'll often see terms like 210 net 30, which means the customer can take a 2% discount if they pay within 10 days. Otherwise, the full amount is due in 30 days. Let's say a customer who owes $2,000 pays within the 10-day period. They get a 2% discount, or $40. When we receive the cash, the entry is a three-part compound entry. A debit to cash for $1,960, a debit to the contra revenue account, sales discounts for $40, and a credit to accounts receivable for the full $2,000 to clear their balance. So, how do all these pieces come together? We present them on the income statement to calculate our final net revenues. We start with our gross revenues from services and sales. Then, we subtract each of our contra revenue accounts. We show less sales returns of $200, less sales allowances of $400, and less sales discounts of $40. This gives us our final net revenues of $1,960. This is the true measure of the revenue generated from these transactions. These transactions are also reflected in the accounts receivable T account, which you can see is now zero after the customer's payment. And that's how we get from gross sales to net revenues. The key takeaway is that while trade discounts are handled by simply recording the net amount, sales returns, allowances, and sales discounts are tracked in separate contra revenue accounts to give managers better information. This process ensures that the income statement provides the most accurate and transparent measure of a company's sales performance.